All right, today we're diving into a company that's, well, it's way more than just a business. It's a strategic national asset, really a cornerstone of India's entire maritime security. We're talking about Mazagon Dock Shipbuilders, or MDL as you'll often hear it called. And this image, wow, it just says it all, doesn't it? What you're looking at right there isn't just some product rolling off an assembly line. No, no. That is a projection of national power. This is exactly why they call Mazagon Dock the shipbuilder to the nation. They are literally at the very heart of India's naval defense. So the big question is, what makes this company so incredibly unique? I mean, how did it build this position that's not just dominant, but it's like a virtual fortress in one of the most critical industries out there? Let's break it down. Okay, so to really get a handle on their dominance, we have to talk about something called a competitive moat. And in their case, it's a barrier that's so strong, it's pretty much unsinkable. Now, if you're not familiar with the term, a competitive moat is basically a business advantage that's so strong it protects a company from its competitors. Kind of like how a moat with crocodiles protects a castle, right? And let me tell you, MDL's moat is one of the widest and deepest you will ever see. And the sheer scale of this moat it's just staggering. I mean, look at this. When it comes to building submarines, MDL isn't just the market leader, they are the market. A 100% monopoly in India. Let that sink in. They're the only company that can build them. And even when you look at surface ships, they're still holding a commanding 45% of the market. It's just incredible. So how is this fortress defended? Well, the walls are incredibly high. First, you've got massive technology barriers. We're talking about super complex submarine tech that's been built up over 30 years. You can't just replicate that overnight. Then there are the regulatory moats. This is a strategic defense sector, so it's heavily controlled. Add to that their one-of-a-kind facilities in Mumbai, a super skilled workforce, and of course, a rock-solid, decades-long relationship with their main customer, the Indian Navy. All right, so let's pop the hood and look at the numbers, because a strong market position is great, but it's the financial strength that really turns this thing into a fortress. Let's see how it all translates to the bottom line. First up, let's talk about their order book. We are looking at a massive 68,500 crore rupees. That number is just wow. What that means is they have a guaranteed pipeline of work, a confirmed schedule stretching all the way out to 2032. Think about that. That's a level of certainty and visibility that most companies can only dream about. And here's the real foundation of that financial fortress, a debt-to-equity ratio of just 0.18. Now, in simple terms, that just means the company has almost no debt compared to its assets. For a heavy industrial company, a number that low it's just astonishing. They're basically debt-free, which gives them incredible financial flexibility. And if that wasn't enough, this next number drives the point home. A negative net debt to EBITDA ratio. Okay, I know, that sounds super technical, but what a negative number here means is really simple and really powerful. The company has more cash in the bank than its total debt. So they're not just low on debt, they're actually net cash positive. They've got cash to spare. You know, this quote from the FinMagina analysis just hits the nail on the head. It's a strong balance sheet with minimal debt and robust cash generation capabilities. It's not just one thing, it's that powerful combination that makes them so financially solid. Okay, so we've established they have a dominant market position and a balance sheet that's built like a fortress. But what's next? Where do they go from here? Let's take a look at how they're steering towards the future. And believe me, the wind is definitely in their sails. They're being pushed forward by some really powerful government tailwinds. You've got the Make in India initiative, which is a huge deal, plus a defense budget that just keeps climbing, hitting 6.21 lakh crores. That's a massive tailwind for a company like this. And MDL isn't just sitting back and enjoying the ride. They have a very clear plan to catch that wind. They're zeroing in on huge projects like the P-75I program for 6 new advanced submarines. They're also pumping money into technology and digitalization, expanding their facilities, and even looking to export to friendly nations. It's a multi-pronged strategy. Now, here's something really interesting. You'd think with this kind of dominant position, the company's valuation would be through the roof, right? But it actually looks pretty attractive. If you look at the price-to-earnings ratio, which is just a simple way to see if a stock might be over or undervalued, MDL's is actually lower than its peers, like Garden Reach and Cochin Shipyard. But of course, it's not all smooth sailing. Every journey has potential storms on the horizon.
So to get the complete picture, we absolutely have to talk about the headwinds and the potential risks that Mazagon Dock has to navigate. So you really have these two competing forces at play. On one side, you've got those massive tailwinds, the rising defense budget, the geopolitical situation, the Make in India push. But on the other side of the coin, you have some pretty big headwinds. We're talking about incredibly long project timelines, like 5 to 10 years. You've got a total dependence on government budgets. And you have pretty limited power to set your own prices. And if we drill down a little deeper, some of the key concerns for investors are pretty clear. The big one is having basically a single customer, the Indian Navy. Their revenue can also what we call lumpy. That just means money doesn't flow in smoothly. It comes in these huge chunks when they hit a major project milestone. And of course, with projects this complex, there's always a risk that something could go wrong during execution, not to mention they need a ton of cash on hand just to keep things running.
Okay, so we've looked at the competitive moat, the financials, the growth plans, and the risks. Let's pull all these threads together now and take a look at the big picture. What does it all mean?
At the end of the day, it really boils down to this. Mazagon Dock is a truly unique company. It's a strategic national asset with a genuine monopoly in a critical industry. It's got that fortress-like balance sheet we talked about, and it's being pushed forward by some very clear growth catalysts. But all of that, it's balanced by the real long-term risks that just come with the territory of these massive, complex government defense projects.
And that really leaves us with one final big question to ponder. As a nation's ambitions on the world stage continue to grow, just how vital does the sole builder of its underwater fleet become? That's definitely something to think about.